It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Trump has done it. He is banning large institutional investors from buying houses. I'm going to discuss some of the impacts that I believe this is going to have. But before I do that, I really wasn't planning to talk a lot about real estate this week, even though I have the last few weeks. I've had a lot of people reach out to me. I really appreciate it. This is a topic that has a lot of interest with a lot of people. I was going to focus a little bit more on the stock market and precious metals this week, which I'm definitely going to touch on with precious metals. But the reason why I'm going to lean more on the real estate and precious metals today is there's not a whole lot going on with the markets that's surprising or unexpected. If you've been listening to the show for a while, you know that the S&P 500 over the last couple of years has been on a tear, a tremendous run-up, historical levels of increase, and a lot of people are asking, what do you expect to happen from here? Obviously, no one knows truly the answer, but if you look at history and you look at the signs and you look at indicators, typically after you have a really strong run-up, you're going to have some volatility. We're seeing that since the first of this year, January 2026, for example. Ups and downs of 5, 6, 7%, not unexpected. For example, the last run-up from 2024 to early 2025, we saw a correction in early 25 where the S&P hit about 6,000 and dropped to about 5,000. Should we expect something like that to happen again? Most likely. I mean, the very early part of this year, the S&P 500 got close to 7,000. Should we see it pull back to, say, around 6,000 or so? Wouldn't be surprised. But again, after really strong run-ups, the typical history, you can look at charts, you can look at the history. This is nothing new. This is no surprise. Usually you have a period of uncertainty, which creates volatility. The market has to catch its breath, basically. Could we see some fairly significant corrections just as a normal part of the process? Absolutely. If something occurs economically where there's some real concerns, obviously we could see something more than that. Frankly, in my opinion, there's just not a lot of new news regarding the markets. What's happening is to be expected. No surprise, frankly. And as I said to somebody earlier this week, and they even brought this up, they try to look at it every day, but it just kind of gives you an ulcer. That's pretty accurate for most people. I understand there's some people listening that enjoy watching the markets day to day. That's their thing. But I can tell you the fact of the matter is for the vast majority of people, that is not the case. Human behavior studies show this. About 80% of the human beings are just not built for taking on that type of risk. So as this gentleman pointed out, it just kind of drives you nuts trying to watch the ups and downs and the gyrations day in and day out and kind of gives you an ulcer. So it's probably better to set it and forget it, if you know what I'm saying. And if you're one of those 80%, that's why an index annuity is probably the best option for you. We have products with indexes that have averaged double-digit returns for the past decade plus, literally, with no downside market risk. So if you're one of those people that like the idea of the unlimited upside growth without the downside risk, you don't want to get the ulcer or be anxious or concerned or worried about the ups and downs and gyrations and when it does correct, by all means, contact me at yourpersonalbank.com. I can show you some of the best index products out there. I can share with you why. I can show you the actual returns from the index performance reports. This is proprietary information. Vast majority of advisors and agents do not have access to this. I'm independent. I'll show you I have access to literally hundreds of annuity products, index annuity products, and hundreds of indexes with the actual returns. So you can see which ones have performed and which ones have not. 1, 5, 10-year history. Without that proprietary information, you're kind of flying blind and in the dark. No offense to the agent or the advisor, but how do you really know? And if you're looking at an index that, let's say there's many of them, folks, the majority, in fact, close to 80%, literally average low single digits historically over 5-10 year periods. Look, if you've got an index that has never really done a whole lot, what makes you think it's going to in the future? Versus if you have an index where historically has gotten strong returns or average strong returns over periods of time of a decade or longer even, the odds of it doing well in the future when the markets cooperate are much, much higher, aren't they? And this is true whether you're looking at index products, whether you're looking at any type of investment tool subject to the market, where the returns are based on indexes or stocks or different factors in the market. But again, the other advantage, significant advantage with index annuities is the principal is guaranteed. There's no downside market risk. And each year that you lock in the gains, and each time you lock in the gains, typically annually, if there is then a correction, well, that's your new principal. So if your account goes up and the market corrects, goes the wrong way, you get to keep the gains. You don't have to ride the roller coaster down, so to speak, and then back up again just to get back to even. Obviously, is lost time. Some people think there's going to be another leg up. I don't hear that very often, but there are some. Majority of people think we're going to see a significant correction. For the next leg up, there's going to have to be a significant reason behind why that would occur, because again, it's gone up so far so fast over the last couple of years. But no big news there, frankly. The new news really is in the real estate world. President Trump just torched big companies for ripping off American middle class by buying up houses en masse, as he stated, and he's calling on Congress to codify his ban on this practice. As President Trump states, a person sweats, works, buys one house, and can't take depreciation, yet an investor can. This is not fair. He pointed out, America will not become a nation of renters. That is why I am banning large investors from buying single-family homes. It's not fair to the public, and I'm calling on Congress to pass that ban into permanent law. Now, I believe this is going to have an impact on the real estate market, especially at this point in time. There's been discussions and arguments even whether this ban will help or hurt the affordability of single-family homes. I myself have even been kind of on the fence on both sides of this. Certainly, initially, the idea sounds good on the surface, but what's the impact going to be? Now, there's some other reasons why he's implemented this ban, and they're valid. For example, it's been a known scam for investment groups to sell homes back and forth between them at higher and higher prices just to inflate the comps to increase their portfolio worth. This has been happening over the past several years. It's an undeniable fact. And this is part of the reason why comps have gone up so much. The price of homes have gone up because these investor groups, these large institutional investors, have forced the prices up by, like I said, by selling to each other. And frankly, that's not right. It inflates their portfolio value, so it makes it look good for investors. Of course, that's bad for individual homeowners. And even those that already own a home, it's impacting them negatively also. I spoke to 2 people last week alone who bought homes, unfortunately, it turns out, at the peak. They bought into the idea, they were told that, well, go ahead and purchase now because interest rates will go down. So they bought around 2020-ish, that time frame, assuming the interest rates would go down in the future, they could refinance and then better afford the monthly payments. Unfortunately, that has not happened yet. And one thing I share all the time, I even shared this on the show, that is terrible advice because you're counting on something you have no control over, and that is interest rates. Now, a common misconception is the Federal Reserve has an impact on mortgage interest rates. It really does not. Mortgage interest rates are based on the 10-year Treasury plus 2 to 3 points. And what impacts the Treasury yield or the Treasury interest rates is government debt. The biggest impact is that because as the government sells more bonds because they're spending more money, they have to increase the interest rates that they're paying investors to buy the bonds. Basic supply and demand. And one of the questions I get all the time is higher bond interest rate yields, how long is that going to continue? Well, there's a real easy way to pay attention to this. When you see our federal government debt start to decline or get under control, in other words, Congress stops spending too much money, then you might start to see some reductions in bond interest rates, or bond yields, that is, what they pay. Now, so far, we're seeing no sign of Congress spending less money. In fact, they're still spending far more than they receive. So no reasonable person I've talked to thinks that we're going to see a reduction of debt, of government debt, anytime in the near future. Therefore, we're going to see higher bond yields for longer. Even the Federal Reserve, you hear them state higher interest rates, higher for longer. Therefore, the idea that mortgage interest rates are going to decline significantly in any time in the near future, in my opinion, is just false. There's no evidence for that. In fact, all the evidence points the opposite. So unfortunately, people bought into the idea that, hey, I'll go ahead and buy this property. It's gone up probably a little more than I could afford, but I want to get into it, and the interest rate's higher than I probably can really afford or sustain long term, but interest rates will drop in the future. And who told them this information? Primarily real estate agents, mortgage brokers. Why? Well, they benefited if you purchased the home, didn't they? But if you looked at the economic situation, and if you understood that mortgage rates are based on bond yields, not the Federal Reserve interest rates, that's a very common misconception, you would recognize very quickly that bond yields are unlikely to go down anytime in the near future. I've shared that again on this show repeatedly over the years. Education and knowledge are key. One of the things my wife shares with me all the time is if you want to learn how to play the game, you got to learn the rules, right? If you're going to win. So you got to understand the rules. So I do believe this ban on large institutional investors on purchasing single-family residences will have an impact on the real estate market, particularly in the shorter term, and particularly at this time, because there's a number of things going on with the real estate market. We're going to see some adjustments, maybe even significant adjustments. Well, I'm just going to tell you, stay tuned, because I'm going to share the reasons why, so don't miss it.
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So Trump has recently announced a ban on large institutional investors from purchasing single-family homes. Now, I'm not certain exactly how that ban's going to come into play. He's also calling on Congress to make that permanent law. So I assume if it's just a executive order that there will be lawsuits and such. But if Congress does pass the law, it will become law. So it'll be interesting to see how this plays out. If this ban does, in fact, come into place, I think it's going to have a real impact, short term, at least, with the real estate market. And here's why. I shared last week, in fact, where Lennar, the second largest home builder in the United States, is now selling homes at pre-COVID level prices. At the peak of the pandemic, around 2022, they were selling homes for about $511,000 and are now selling homes at $375,000. Well, folks, that's a 27% price cut. That's $125,000 less, essentially, for the same home. And this is actually putting some people in a bind who purchased those homes at the higher prices. In other words, I spoke to two folks last week. Their home values were underwater. It was already below what they paid for it. And on top of that, the property taxes have increased on them significantly. They were hoping to refinance at lower interest rates in the last segment I shared, where that was a fool's errand, frankly. One, you can't control interest rates. Why would you invest or purchase something where you have no control what the future rates are going to be? In other words, if you were counting on a lower interest rate in the future, you should have never committed to it in the first place. Plus, the writing was on the wall. Interest rates going lower in the future was highly unlikely because of bond yields staying higher due to the government debt. But that's a whole nother story. But again, we're running into people now that are starting to have issues. And not only is it Lennar, the largest home builder now, D.R. Horton has been dropping prices on their new homes significantly. Some parts of the country, like the Southeast and the West, they have a record amount of new homes built, or some of the highest numbers ever seen. The home builders went crazy buying new homes, which is good from a housing affordability standpoint, because we have a shortage of homes in this country. Part of the reason why they built so many homes is they knew they would have an in buyer. If they weren't able to sell to an individual family, there was these large institutional investors that would pick up many of these homes. Now, if they're banned from doing that, what are these home builders going to do with all this inventory that they cannot sell to the large institutional investors now? Well, that's going to be a downward price pressure, obviously. Also, as I shared last week, the lock-in effect in terms of mortgage rates is fading. Recently, for the first time in about 5 years, the number of people who have 6% plus mortgage rates now exceed the number of folks who have 3% or less mortgage rates. Obviously, those with the lower rates were reluctant to sell because if they sold their home and had to pick up a new mortgage, it was going to be double probably, so they stayed. But now that is fading as fewer and fewer people still have those low interest rate mortgages. Now, we have another factor going on. This is some of the latest numbers we've seen. We have the largest recorded gap ever between sellers and buyers. Currently, the number stands at about 530,000. In other words, there's over 500,000 more sellers in the country than buyers currently. But interestingly, the number of buyers has been on a steady decline since 2023. The number of sellers has done nothing but go up until very recently when it's starting to pull back a little. And most people believe part of the reason is many of the sellers are still holding on to the higher price points that you could get a year or two ago, and they're more reluctant to sell as the prices continue to decline. Now, depending on their necessity to sell, if they need to sell, they're going to have a problem. I was looking at 2 properties, for example, very recently. The people had purchased the property a year and a half ago, so mid-2024. They listed the property for sale about mid-2025, about a year later, at a higher price point than they purchased. But in both cases, the prices have been steadily declining. They've been dropping their price every few months, and now in both cases, they're right at the point of what they paid for it a year and a half ago. Now, depending on their situation and how desperate of a seller they are, in my opinion, I looked at the prices they were trying to sell for and what the market value was, and they were still easily, in both cases, 10-20% above the market value, or estimated to be right now. And in most parts of the country, if you look at price projections for real estate, outside of, say, the Northeast, most parts of the country, it's projected that the prices are going to drop another 10% from where they're at now. And if you're looking at the boomtown areas like Austin, Texas, for example, being the poster child, but a lot of places in Texas and Florida and the Southeast in particular, where home builders have built a number of these homes, many of the price projections in those areas are 20% projected to decrease from where they are right now. So I believe one of the reasons why you're seeing so few buyers, prices are still above levels where they're affordable. Interest rates are too. But they're also, buyers are looking at, hey, if I don't have to buy right now, do you want to catch a falling knife? Go on Zillow or anywhere else, and if you're looking at property, the one thing you're going to notice in most parts of the country, again, the Northeast being an exception, and a lot of price reductions. And if you look at a property, you can see where, a month, 2, 3 ago, it was dropped and 2 and 3 and 4 and 5 times, and it was taken off the market and put back on the market. You're seeing very, very few price increases, almost none in many places, many parts of the country. So where's the bottom going to be? And the question I get asked oftentimes is, well, how do you figure that out? Well, one way to determine if you're at a bottom, I don't know if it's going to be the bottom, but a bottom is when you stop seeing so many price reductions. When those kind of start going away, then we're probably approaching something of a bottom. And if you start to see some price increases instead of price decreases, maybe we're starting to recover from there. Most projections are 2026 is going to be a rough year for real estate in terms of prices. Another reason why, and I shared this last week, and this has got a lot of comments from listeners, is I had two clients, similar situation. They were real estate investors using hard money loans to invest, to purchase properties for either buy and hold long-term rental. In one case, the other, they're a contractor, they build their own. But in both cases, they were actually underwater now because of the pricing and the interest rates. If you borrow private lending, you're probably paying 12, 13% in most cases. Well, if you use your personal bank, you can put it into a policy, make 6.5% dividend, or index returns, which have averaged 8 to 10% over the last 20, 25 years. And the cost of borrowing is somewhere between about 5 to 6%. Well, if you're making 6.5% with guarantees, or even upwards of 8 to 10% with index returns. So let's say your returns are range from 6 to 10%, depending on the type of product you have, that type of thing. And your cost of borrowing is around 5 to 6%, depending, again, on the product and the source of funds, that type of thing. What's your money doing? Well, obviously, you're earning more than it cost you to borrow, so you keep the difference. So not only in this case, in both of these clients' situation, where they eliminated the cost of borrowing, the 12, 13% cost of borrowing, they actually, by putting money into the personal bank policies and borrowing against it, they were not only eliminating that, but they also gained the positive arbitrage, anywhere from about 1 to upwards of 4 to 5% even, on money they spent and used to invest in real estate. By eliminating the cost of borrowing, that's an expense, and actually picking up some positive arbitrage, ran the numbers with one client. Their purchases currently were costing them about $500 a month, negative arbitrage using private lending, to positive arbitrage because of the difference of the expenses. So your personal bank was able to take a business that was losing money and turn it into a business that became profitable. Now, it doesn't even have to be real estate for this to work. This could apply to any business or investment project, anything that you have, any situation where you are borrowing money. By reducing or eliminating your cost of borrowing, you can turn a negative cash flow situation in a business project to potentially a positive one. Or if you're borrowing money to buy something, buy an item, or pay off debt, you can greatly reduce your cost of borrowing, the interest you're putting out. You can pay off debt far quicker. You can reduce the cost of borrowing significantly or eliminate it altogether, as I stated, which can make a big difference in the cost of purchasing something. I mean, I found this, 3 years ago when I was purchasing a new truck, and I bought it right before the interest rates went up. And when I found the truck I was looking for, it happened to be at a dealer. It was a 2-year lease return, which I often recommend purchasing that way. Why buy a new vehicle when the depreciation on many of them really hits you hard in the first couple of years? So I found a good deal price-wise, exactly the pickup I was looking for. Went into the dealer, and I was willing to pay cash because, well, fortunately, I had the funds available to do so, and I could access them through my personal bank policy. And at that time, I was earning 6%, cost me about 3% to borrow. I was still going to make a 3% positive arbitrage on the money, even if I used it to purchase the vehicle. When I went to purchase the vehicle, I asked, well, what's the lowest interest rate loan you can give me? And at that time, they said they could give me a 3% loan. Now, today you can't get that, I understand, but I'm sharing this because I want you to understand a principle, and it's this. If you can borrow money at a lower cost than you're earning the funds, well, you get to keep the difference. By the way, this does apply for a lot of people with mortgages today. I'll run into folks quite often that'll have, say, a 3% mortgage, and they're paying it down early. And I ask them a simple question, why? Now, usually it's because they want to pay off the interest sooner, pay it off quicker. I understand that. I understand the motivation. If you can earn 6%, insured, with guarantees, tax-free even, why in the world would you pay off a 3% mortgage? You're actually giving up 3%, aren't you? That's called positive arbitrage. You're actually better off investing in the asset that gives you the 6% return than paying off the 3% loan. And one question I ask all the time is, well, would you rather have a home paid for, or would you rather have a low interest rate mortgage on a home and the cash set aside in an account earning a higher interest rate, say double, guaranteed, tax-free, and highly liquid? Well, the answer always is you'd rather have the cash, the account, because it's liquid, it's accessible. What if you need it? This is one of the key principles about the personal bank concept, interest rates, all those kinds of things that are powerful. And it's a paradigm shift in thinking, but it's understand how the wealthy operate and why you can have more money, make your money go farther. You can reduce your cost of borrowing, pay off debt quicker. Items you purchase essentially would be cheaper then. And there's a question I asked this finance manager, shocking but not surprising. The question I asked him and then the answer in the next segment. So I'm going to encourage you to stay tuned.
This is Ference, host of Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you'll reach me. It's yourpersonalbank.com. So in the last segment, I was sharing the idea of positive arbitrage, how you can make your money go farther, how you can pay off debt quicker, how you can reduce the cost of purchasing items, reduce the cost of borrowing, eliminate it even earn interest on money you spent or invest or use elsewhere. I shared with 2 clients last week how they had real estate investment businesses where they were, because of the price of homes and the rents going down and their cost of borrowing using private money lending, was causing them to be in a negative cash flow situation. Now, that's not good for business. You don't want to be investing in property and making less than you receive, right? I mean, I think everyone understands that. Well, using your personal bank, eliminating the cost of borrowing, even giving them a positive arbitrage situation where essentially they're earning more in interest than it costs them to borrow to purchase these properties, we are able to turn a negative cash flow situation into a positive one. And this is super powerful, and yet most people don't understand this. And I'm going to illustrate the point. I was sharing the story of me purchasing a vehicle about 3 years ago. I was in the dealer talking to the finance manager, and I was trying to determine what the lowest interest rate loan I could get on this vehicle or pay cash. Because the argument is, should you pay cash? Should you finance? Should you use your personal bank? Well, there's a real simple solution to this. People ask me all the time, should I borrow the money, or should I use the funds in my policy, or should I pay cash? And the answer is, what is the cost of borrowing? Should you pay off debt? Should you pay off any debt? Well, is it less than what you can earn on the money reasonably with some guarantees? You don't want to put it at risk, understand. We have your personal bank policies are paying 6.5% dividends with guarantees, tax-free. So if you can earn 6%, for example, on your money, why would you pay off a loan where the interest rate was less than 6%? That makes no logical financial sense. I know there's arguments out there about people paying off debt. There's gurus out there that are famous about teaching people to pay off all your debt. That is not necessarily the best advice for everyone, and it's too black and white, in my opinion. And again, if you're smart about money, debt can be your master or your slave. You can control it, can benefit you, or you can become a slave to debt. That's biblical even. So just like you want to master learning how to earn more money, you also want to master learning how to spend less. And one of the best ways to spend less is pay less interest on debt, pay it off faster, or at least earn some positive arbitrage on it. What do I mean by this? If you have a low interest rate mortgage, let's say around 3%, and you could earn 6% on that money instead of paying extra on the mortgage, it makes no financial sense, no logical financial sense to pay it off early. Sure, make your minimum mortgage payment. Of course, you have to. But any extra, you should pour it into a policy with guarantees and make basically double the money on it. If you do that over the next decade or two, or however long your mortgage payments are, you'll have twice the amount of money available to you than if you pay it off the mortgage early. If you want to learn more about this, contact me at yourpersonalbank.com. I'll be happy to share with you your situation and show you how you can make your money go farther. You want to be just as smart about debt and debt management as you are about making money. That's the bottom line. Now, this question I asked this finance manager, it was a major car dealership. I was able to secure at the time a really low interest rate loan, about 3% auto loan. Now, you can't do that today. I understand. This was about 3 years ago. And my point was, well, I might as well borrow the money at 3% because if I leave it in the policy, I'm making 6%. So it'd be dumb to pay cash. You see what I'm saying? I hope most of you understand that. I asked them this question. I said, how many people that you meet with, talk to, discuss with you this type of thing in terms of minimizing the overall price, minimizing the interest paid out, that type of thing, instead of just talking to you about the monthly payment? And he looked at me. He says, I've been the finance manager of this particular dealership for 12 years. You're the first one. I said, you've got to be kidding me. He said, no, you are the first one to ever come to me and ask me these questions. Like, what was the total amount with interest? Which is, by the way, it's called a truth and income statement on a mortgage statement or any loan. You have to look at that number because that's the actual price you pay for something, whether it's a vehicle or a house or anything else that you finance. If you don't look at the truth in lending statement, the total amount you're going to pay if you make all the payments out, including the interest, you're just deluding yourself. You want to understand that's the actual amount of money you pay for that item. It's not the monthly payment. If you can afford the monthly payment or not, that's immaterial. You have to look at the total cost, and that's real money, folks, because that's money you make that you pay to a lender, don't you? It's blood, sweat, and tears, investment, whatever. To not look at that is financially foolish. And this is one of the most basic common mistakes I see made with the vast, vast majority of people. Now, if you're going to purchase that item, whatever it is, and you're okay with that total amount, if you pay it out, all the payments financed and everything, so be it. But at least be aware of what the number is. And if you want to reduce that or earn some interest on the money while you're paying those payments, well, your personal bank can be a great tool to do that. As I stated, I've done with my vehicle purchase I made about 3 years ago. You can learn how to make positive arbitrage on your money while you're paying those payments and pay down the debt faster and earn some interest on it. You're earning more than it costs you to borrow to pay it off, which means you get to keep the difference, which means your money's still making some for you while you're buying that item or financing that item or paying down that debt or whatever it may be, or investing in something else. This is how you make your money go farther. And the fact of the matter is, especially in this day and age where credit card debt is at all-time highs, consumer debt is at all-time highs, inflation has wrecked the budgets of the majority of Americans. The cumulative effect of inflation over the past 4 or 5 years has been devastating. It's more important than ever to look at ways of being more efficient with your money and to put your head in the sand and be an ostrich, as we all often call it, will do nothing to help you move forward in the future. And even if you are somewhat savvy about money, what I do find is a lot of people have multiple buckets of money. They got assets here and there and whatever, and there's not an overall strategic plan. Now, they've done well financially overall, but there's so many things they could do to make it more efficient or increase returns. I met with one client last week, and then we finalized some stuff this week. But one of the things we found is they had some investment accounts for their grandkids, for example, and they'd had them there for over a decade and did not realize until we reviewed the statements that they were in a brokerage account. And I won't say the name of the company to embarrass them. They were invested literally in just money market accounts, earning zero interest. So this money had sat there for over a decade. These were not stupid people. They were financially, had done well, worked hard, invested, had quite a bit of money invested in various different places, and did not realize that these accounts were just sitting there doing basically nothing. Obviously, they were not happy about it. And when I met with him, in fact, yesterday, he said, by the way, I called them and I let them have it because I was pissed when I found that out and I had no idea. Folks, I find this type of thing more often than not. I had another client who had a couple of different accounts and was asking me some questions about it. And the bottom line is, although they were both invested similarly, one had quite a bit more fees than the other. So they were looking at reallocating, by the way, into an index annuity to eliminate the market risk because they're concerned about that, and fees, by the way. Which one of them should they concentrate on more? Everything being basically equal, one having more fees than the other, that makes it an easy choice, doesn't it? And they had no idea of that. And that's just experience that I have, 26th year in the financial world. We learn that kind of stuff. So there's things I can bring to the table, even if you're a fairly savvy investor, that you may not be aware of. The last thing I want to share about real estate, and then I'm going to switch gears to precious metals. Before I do that, real estate has some unprecedented challenges. The first-time home buyers, average age currently is 40. That's the highest ever recorded. That's not healthy. That's not good. But I just saw another statistic about real estate. Home buyers over the age of 70 now outnumber buyers under the age of 35. That's not healthy for the real estate market, for the economy, or society. These are not good things. So I'm hopeful that things will start to turn around and get a little bit better. Affordability is most likely going to increase. In other words, prices are likely going to be going down. Look, I understand if you own a home already or you bought at the peak, that's not good for you. But again, having a market where the majority, 70% of Americans can't afford the average home. When the average American cannot afford the average home, that's not healthy. That's not good overall. So yes, some people are going to get hurt. Some people made some bad decisions. Some people bought at the wrong time or bought into the idea that they could buy now and lower the, refi at a lower interest rate in the future, which hasn't happened so far. If you have those kinds of situations, again, contact me at yourpersonalbank.com. Got a ton of experience, not only in the financial world, but in real estate too. Personally, my wife and I have owned 32 properties at one point. And I've got a ton of real estate investors, been in the business for decades even, and some of them still currently active. These are things I can bring to the table that might be helpful for you in planning your future, better accomplishing your financial goals. See, it's hard for me to tell you cookie cutter box what I can do, bring to the table for you. And each person has different needs and goals. So I find it interesting. It keeps my attention. I don't get bored, so I like that part. And it's a problem-solving process. Looking at your situation, what you have, where you want to go, and what's the best way to get there. And frankly, for everybody, it's a little bit different. So if you want another opinion and you don't want the basic cookie cutter approach that most people get, I'm not picking on them, but if you talk to ABC brokerage firm, you're probably going to get the same thing as XYZ brokerage firm advice for the most part. But if you want something a little different, maybe outside of the box thinking, entrepreneurial mindset, that type of thing, contact me at yourpersonalbank.com. I think you'll be pleasantly surprised. I'm going to encourage you to stay tuned in the next segment because I'm going to touch on some questions and concerns about the precious metals market.
This is Ference, host of the Your Personal Bank Show. Great news! Most insurance companies have announced higher dividends for 2025. They also reduced fees. This will increase cash growth even more than before. This is the best time in over 40 years to consider a high cash value dividend-paying policy. Also, dividends are expected to increase for the next several years. Contact me at Your Personal Bank or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com or the Your Personal Bank app. Yes, you will reach me. It's yourpersonalbank.com. I want to discuss precious metals. This isn't a topic that I bring up often, but I have had a number of people recently asking me questions about it. And this is coming up because if you look at for gold, for example, there's no question that it has had a stellar year. Starting last fall, it really took off. Silver more recently. So it's gotten a lot of attention. And what I find interesting, the first thing I want to say is, it's interesting that different markets, whatever it is, whether it's real estate or precious metals or stocks or anything for that matter, a lot of people don't pay a whole lot of attention to it until it takes off. 2 or 3 years ago, I was getting a lot of questions about tech stocks and NVIDIA and things like that. And my point to many people there then was, as it is with gold or precious metals now, is the best time to buy is probably now, not after it's shot up or doubled in price. You know what I mean? After a huge run up, everybody wants to get in. But generally speaking, if you look at any asset, any chart, it's probably not the best time to get in because it's already ran up huge. So you probably missed the bus, or at least the majority of it. Now, if there's some kind of correction or it pulls back and you think there's a reason for it to go up again from there, you might want to get in at that point. But to get in while it's on its way up and running hard after it's done that for a while, pretty risky. I'll put it that way. Probably not the best place for most people to be. So that's the first thing I want to understand is, at least in the short term, when it comes to gold, silver, most of that type of thing, if you're thinking about getting into it at this point, you probably missed the bus on much of the upside. But if you do want to get into it, my recommendation, maybe wait for some kind of pullback. You know, if it'll come back 20% or so, which is very common. Look at any chart on any asset, and that's typically a very common pullback. So if you see something like that and then you want to get back in, okay, that might make more sense. The other thing I find with a lot of precious metals, folks, is, I mean, it seems to be one of those things a lot of people love. It's kind of a love it or hate it relationship. And I find, you know, the advice that you hear in the industry is, okay, if you want to use it as a diversification tool, okay, that's fine. Most don't recommend more than 5 or 10% of your total assets. Ironically, I tend to find, for the most part, most people either have none of it or they've gone way over 10%. In fact, some cases, pretty much all their assets are in precious metals. Now, if in this past year, it's been great. But you could say the same thing about the tech stocks if you got in 2 or 3 years ago. It's been great. Okay, is it great now? Not so sure. But here's where my biggest concern about precious metals is, and this comes from similar thought process as Warren Buffett shares. You can look, for example, at a chart of gold, and you can see quite quickly that it can sit there and do nothing for a decade and then suddenly shoot up. Why is that? Why does that tend to happen? The main sources, oftentimes, why precious metals increase in value, and particularly gold and silver, is you have a lot of fear that suddenly comes out there. And the sources of much of that, it comes from precious metal salespeople. And they benefit from those fears. There's no question about it. We've also seen recently some of the central banks of the world purchasing more gold than they have in past years. Much of that had to do with trying to more set up towards the BRICS currencies, trying to establish another currency, and part of that process is backing up or having more gold reserves in place. So you had a couple of factors kind of come together that started pushing the prices of gold up significantly. Ironically, if you look at gold, for example, and we go back to some of the peak inflation periods we saw like in 2022, 2023, things like that. Historically, you think high inflation, gold is going to go up in values. Well, it didn't. It really didn't go up at all, just much to speak of. Why? Well, gold, about 80 to 85% of the world's gold supply is owned by the world's central banks. And if you go back to, say, the 2020 COVID shutdowns, you see the same type of thing. Look, the economy was shut down. The S&P dropped 30% in 30 days, that's a time when you would think gold would shoot up in value. It didn't. You go back and look at the charts. Now, initially that confused me because typically, again, you go back to 08, 09, we had a recession, gold went up. It went up for like 3 years back then. But 2020, no, we didn't see. In fact, saw the opposite. Didn't go up. It went down. We saw more recently high inflation. Really didn't see gold do much. Why? The central banks of the world were manipulating the price. Gold and silver is some of the most manipulated assets in the world. Again, if you own 80 to 85% of the supply of something, you pretty much control the price. So one of my biggest concerns about precious metals is exactly that. I often say to people, look, if you trust the central banks of the world, go for it. If not, may not want to participate. But the other issues and concerns I hear oftentimes about precious metals have to do with inflation, currency devaluation, and potentially losing reserve currency status. Now, I've done a deep dive on a lot of this type of stuff, and I want to share some thoughts on this. What I want to say is, although there are some valid concerns, government overspending probably being one of the biggest, BRICS, I think to a lesser extent, I'll share with you why in that in a minute. Many of those concerns are actually overblown, in my opinion, and here's why. Let's first of all touch on inflation and currency valuation. Government spending, creating debt, and reducing the value of the dollar is a real problem, but again, it's somewhat overblown. One of the best ways to measure the economic status of a country is debt to GDP ratio. It's one of the best measures of debt. It's similar to, let's assume you're applying for a mortgage. They're going to look at your debt to income ratio. And by the way, if your mortgage gets above about 30% of your income, generally speaking, you're kind of getting into financial trouble because you don't have enough money left over to service the debt, pay for your expenses. Well, one of the comments by the precious metal salespeople that really push, or I kind of call it fear porn sometimes, the debt to GDP is higher levels in the U.S. it's ever been. If you look at the debt to GDP ratios for the United States, and this is according to the Federal Reserve charts, it did peak out at about 125% in 2020, basically in the midst of the COVID shutdowns. The government helicoptered money into the system and really cranked the debt from about 100% of GDP to 125. Now, by the way, since that point, it's been on the decline. And we're at about currently, based on, again, Federal Reserve statistics, about 118%. Now, is that good? No, of course not. But is it at crisis levels? No. Put it into perspective. Let's assume you made $100,000 a year income, and your total debt was $118,000. And the service on that debt was about $25,000 a year. So you're making $100,000 a year, about 25 of it's going to interest on the debt. Can you handle that? Yes. Is it ideal? No. Are you at crisis levels? No. So that's the thing. One thing to understand. To put things in perspective, if we look at the Greek debt crisis of 2010 to 2015, which is the most recent debt crisis of a first world country, Greece's debt to GDP peaked at about 179% before they were forced into austerity measures, and their debt to GDP has been on the decline since. High debt to GDP, by the way, is not necessarily a guarantee of economic devastation. Let me give you an example. Japan's debt to GDP has been around 220% since 2020. And Japan has not suffered massive economic devastation, high inflation, or anything like that. So although high debt is not good, it does not guarantee economic devastation. Japan is a perfect example. Although I'm not happy about the government continuing spending more than it receives, for the first time in my lifetime, the majority of people are paying attention to how much the government is spending, and the public is paying attention to accountability and fraud. I do believe this will lead to change in a positive way and will help bring our financial situation, our debt situation, will improve if we continue to pay attention and take action. There are challenges to this, I agree, but there is also reason to be hopeful. So again, is it good? No. Are we in crisis levels? No. Now I want to touch on reserve currency status. This one I actually have less concern about than the debt. And that is because the U.S. dollar has been the world's reserve currency, primarily based on the petrodollar, since the 1970s. The U.S. and Saudi Arabia agreed to price oil in U.S. dollars in exchange for military protection and economic cooperation. And this is what ensures a steady demand for the dollar. In 2019, the U.S. became a net exporter of oil, marking a pivotal shift in its role from importer to major global oil supplier. That further reinforces the dollars in oil trade. And all major oil benchmarks, whether it's the West Texas Intermediate or Brent Crude, are all priced in U.S. dollars. There's no plans to change that anytime soon. Combined oil reserves of the U.S. and Venezuela account for over 50% of the world's total oil reserves. So as long as the U.S. controls Venezuelan oil, the U.S. will dominate the world oil market. I believe personally that's one of the reasons why the U.S. went in and took Maduro. This also prevented China from controlling Venezuelan oil, which they were attempting to do. And that is a significant hit to the BRICS currency, and China for that matter. China purchases oil. They're not a net exporter. So although the U.S. economy is weaker than it should be due to government debt, and the debt is caused by too much government spending, far too much waste and fraud, but the encouraging part is the majority, if not all of our deficit, is waste and fraud. If the public continues to pay attention and demand action, it'll make it more difficult for spending to continue to increase in the future. Our country's been through difficult times before. We've dealt with major challenges, far greater than this. Challenges cause volatility, can be very disconcerting. I understand that. But we have, as Americans, have always been at our best when the challenge is large. We really rise to the occasion when you're talking about moonshots. So the bottom line is, I'm not ready to bet against America yet. I don't believe we're anywhere near to losing the reserve currency status. So I hope those thoughts will be helpful regarding precious metals, maybe give things a little bit more balance. I'm not against it, but I don't think it's the end-all be-all either. A small portion as a diversification strategy can make sense, but going whole hog in it probably for most people is not the best bet. If bond yields continue to stay strong, and they will as long as government debt is frankly higher than it should be, index products through index annuities or index universal life will be one of the best products you can own. They have unlimited upside potential, so if you want to bet on America, a lot of things going on economically in the longer term are encouraging. You can benefit from that. If we go through some volatility, some corrections, which I also believe to be likely in the short term, you don't have to participate because the principal is guaranteed. And I think that's the best balance of both worlds at this point. If you want more information, contact me at yourpersonalbank.com. Stay tuned in the next week for more great information. And as long as it's on our money, in God we trust.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.